Yeah, you would have seen that your bank account, you would have received, say for example, let us assume that you have sold, your investment would have gone out and you would have recorded a gain. Now, if you look at this, investment is not there, but you have got this reserves. So, for that, you need to pass the recycling entry, which foreign currency you will transfer to P&L account, revaluation you will transfer to retained earnings. Because there is some confusion, and now the balance sheet looks like this. See, there is a confusion in the study material entry because they have combined it. They didn't pass in separate entries. I'll show you. Okay, we'll write the solution. In step acquisition, acquirer shall do what? Tell me, you tell me before I proceed. Shall, the very first thing, the crux of step acquisition. Whenever step acquisition somebody says, the accounting should strike to you. What is that? In step acquisition, acquirer shall do what? Sorry? Sorry? Remeasure. That's what you are trying to tell. Remeasure the existing investments. De-recognize the existing investment, that's fine. In step acquisition, de-recognition. But he will again recognize it, no? As a, what is that called, that a remeasurement, or we can say remeasurement. Yeah, we say de-recognize it. But remember, if anybody asks you in step acquisition, first of all, you should always say, acquirer shall remeasure previously held equity for goodwill calculation at fair value on acquisition date, and recognize gain or loss in P&L bar OCI. See, anybody asks you on step acquisition accounting, this sentence should be there in your answer. See, de-recognition and all, generally we do that, we understand, we talk in our language here. But if you open the study material and all, you don't see that, de-recognize and all. There is a different word for that. I will explain that. Followed, no? Anytime you have to write any theory on step acquisition, your first thing you should speak about the remeasurement of previous equity and gain or loss in P&L or OCI. Followed? Then you should talk about the recycling. These two are the very key and unique features of step acquisition. One is remeasurement, another is recycling. In case previously, if acquirer has recognized equity interest of acquiree in OCI, see the language. In case previously, if the acquirer had recognized equity interest of acquiree in OCI, such amount shall be recognized on same basis as if the investment is directly disposed of. See, you tell me that you are telling me you are going to de-recognize the investment. No, actually it doesn't work like that. In principle, it's something like that only. We de-recognize it. But what we need to tell is something like this. We are going to remeasure it for the sake of goodwill calculation, and the gain or loss we are recognizing in the P&L. And if you would have recognized any item of the acquiree in our OCI, then definitely we would have accumulated it. And we should treat it the same way as if we have sold it directly. What treatment would have given to that OCI item if we would have sold investments? You said we would have recycled it, or we would not have recycled it. We should do the same thing. So this two key answer should be there in your answer case. Followed, no? Anytime they ask you accounting on step acquisition, this is what you need to tell. Further, The unrealized gain of rupees 100 crore in OCI on FCTR, foreign currency translation reserve, shall be credited to P&L as per Ind AS 21. Why? Because this is the subject matter of recycling. The unrealized gain of rupees 50 on revaluation surplus to be credited to retained earnings as per Ind AS 60. Done. So we explain how we will account. If this was a theory question, you would have finished. That's it. So explain that. Look, how do you account it? We will do the remeasurement. We will do the recycling. In this recycling, 2 items are there. We will transfer it to so and so, so and so. Finish. Okay. Right. Step 1. Now we have to calculate the gain. Gain on previous. Yes, you want the previous thing? Previous equity. What is your gain on the previous equity? Fair value of 30% stake. How much? 9,000 minus book value 8850. You get 150. Gain on 30% equity. Followed, no? So you have calculated the gain on equity 30%. Next, we will calculate the goodwill because we have to pass the journal entry now. They have given me all the information which is required to calculate the goodwill. Second, step 2 or working note 2, goodwill. See, this is my gain on equity, 9,000 minus 8850. So what is my goodwill? What I'll start with the purchase consideration. How much? 25,000. Is it for 100%? No, this is for 70%. Is that 30% NCI? No, 30% is my fair value of previous equity. Yeah, did I made up now 100%? That comes from, what is the fair value of previous equity? 9,000. So I have got 34,000 minus FVNA, fair value of net assets. They have already told you 30,000. So you have got 4,000. So my goodwill comes to 4,000. So can you tell me the journal entries? See, I think this question has come for 8 marks in the examination. Do you feel sufficiently you have done? That you have done the working of a profit, you have explained what you are going to do with the profit, you explained what you are going to do with the OCI, then you calculated the goodwill, and finally you give the journal entry. What is your journal entry? Net assets, account debit, how much? 30,000. Goodwill, 4,000. To cash, 25,000. To investment in associate. This is derecognition. But we don't tell that in our theory. In our theory, we'll say remeasurement. Learn that language to communicate. We understand it. How much? What goes out is the book value, no? So to P&L gain, or you can write the gain and then you transfer to the P&L, 150. Done? Is there anything else? 2 marks. Is there anything else? Then we have to transfer. No. What we explained there. So next entry will be FCTR to P&L. FCTR reserve. We can say FCTR for reserve account debit to P&L. How much? 100. And the last one, revaluation surplus debit to retained earnings. 50. Done? This is your entry. And if you open the study material, no, you may probably find this journal entry. Have you understood this journal entry? What they have done? They have clubbed this P and L together, which is 150 plus 100. Followed, no? Yes. So next question. This came in your examination. Yes. Please pause the video. You need not write the theory. If you want, you can leave the space. You can write it later. Quickly do along with the journal entry. And see again for our what is that called? To be on the safer side. Whenever you come across this, no, I don't know when they do, when they don't do. In accordance with the applicable Ind AS, give the reference of the Ind AS number as per Ind AS 3, 103, business combination. You have to tell the name. Simply you cannot say Ind AS 103. So you should learn the name of the Ind AS also. Because I believe 1 mark may be there for this. So learn it. Yes, students. So please pause the video and do this. Let's compare the answers. Yes. Is this was there any catch in the question? Nice question, no? So you have to address this question in the exam. Like you have to take up these questions, irrespective of where it is appearing. Even though don't have that the feeling that you have to write the compulsory question only. Better you try the compulsory question later, because generally they will have a play there. And if you see this, why the question asked, because is a conceptual question sitting in the study material. So first you explain the theory, telling that it is a subject to remeasurement, recycling, then there is a transferring to P&L account, OCA and all, the same theory you will write. So the gain will be 81, which you need to recognize. And then goodwill calculation, you will get a goodwill of 2160, 13,500 is the purchase consideration, equity interest is 4860, fair value of the net assets is 16,200. I think every language is also same like study material, no twist in the study question. It's a plain question, only numbers are changed. Good. And your journal entry will be this 16,200 identifiable assets, goodwill, bank investment to gain, and then you will pass FCTR reserve to exchange difference, revaluation reserve to retained earnings. Alternatively, you could have given one combined entry also. Yes, so we have learnt about the step acquisition. So now we will learn about the next step, NCI. So you remember the sequence in which we are coming. We started with the, see there are 4 steps in business combination. Which is the first step? Identify the acquirer. Second, acquisition date. Third, recognition and measurement principles, which says that measure at what is that called, fair value. And the fourth one is calculate the goodwill. Goodwill has got 4 steps. First thing is purchase consideration. Purchase consideration includes certain things, it excludes certain things. We discussed it one by one and I gave you final format. Then second, we need to add the fair value of previous equity. that we already discussed. And the third element which is missing, which makes this 100% in equity, is your NCI. Now, how to value NCI? NCI is the equity in a subsidiary which is not attributable to a parent. So, a vested and a pre-combination non-replacement award is also an NCI. Now, you understand? Not replacement award, non-replacement award. How do you measure NCI? The standard says two things. Look, your NCI can be an equity capital, preference capital. If it is a preference capital, you don't have any choice. It is just like any other liability, you have to always value at a fair value on the acquisition date. But if it happens to be an equity share, yes, I will give you an option. The option is you can measure the NCI at a fair value. We also call them full goodwill method. Or we can value them with the proportionate net assets, because you would have identified individual assets fair value. Which is fair value? This is the market value. This fair value is the market value. Like whatever business value into 10%, 30%. And this proportionate net asset is nothing but individually you would have fair valued assets, no? Fan, tube light, building, land and all. It's a proportionate, say 30%. And it is your choice. It's one time choice. You have to choose it. Will I go to value this way or this way? So this method is called a partial goodwill method. What is the difference? In full goodwill method, you will recognize goodwill to the extent of NCI also. In partial goodwill method, you recognize the goodwill only to the extent of parent. Now, this concept is very much required when you do consolidation and impairment, goodwill impairment. Because in goodwill impairment, when we impair the goodwill, first thing we have to see goodwill came from where? 103. And the moment you adopt any one of the method, goodwill value is going to be different. Both the method cannot give you the same different goodwill value. Because here full goodwill means parent goodwill plus NCI goodwill. Here only parent goodwill. What is the definition of goodwill? Goodwill is equal to purchase consideration minus FENA. Since under partial goodwill, what is NCI? NCI is FVNA into percentage of NCI minus percentage of NCNA. That's why you don't have any goodwill as such for apportionable to the NCIs. But here what happens? You calculate NCI by taking the market price. Sorry? I'll give the example. Again, even though when you solve the problems, you'll understand it. Here, full goodwill means what we'll take? We will take the market price and multiply the number of shares, whatever they are holding. So definitely that will be different from the percentage of FCNA, what they are eligible for. That's why you will have the goodwill. We'll do the problem. I'll explain you. Okay, so that time you can get a better understanding as we solve the problem. Still, if you are not clear, you can discuss. Take out question number 5. Company pays 800 crore for 80% interest in B. Now A is the acquirer, B is the acquiree. The fair value of the net asset is estimated to be 750 crores. If you would have acquired 100%, 50 crores is was the goodwill. Now using the valuation technique, the fair value of the remaining 20% of NCI is measured to be 180. See, remember, in every question they may not tell you which method of goodwill valuation to be followed, partial goodwill or full goodwill. If the question is very silent, you don't have any option. You can make an assumption, but the question is very silent. Always go for proportionate net assets or partial goodwill. If they give you value here, something like this, then they want you to follow full goodwill method. Don't take any assumptions in such case. But here they said calculate the goodwill under both the alternative options. Okay, right? Solution. There are two methods of goodwill valuation or NCI valuation, you can call it. Fair value method, proportionate net asset, PNA method, FV method and PNA method. I will always start with the purchase consideration. What is the purchase consideration did you pay? How much purchase consideration did you pay? You paid 800. Is it going to change based on your valuation? No. Do you have previously held equity? How much? What is this? No. Previously held equity is there? No. Because anything I need to look all the three components on the debit side, on the credit side. What is my NCI now? Now they said calculate both the methods. So if I go for a fair valuation method, generally they would have given me. If they don't give me, I can also find out like this, 800 divided by 80% into 20%. If they don't give, worst case. But since they gave me, I will write 180. For a proportionate net asset. Now, how did you get this 180? They said valuation technique. God knows, no. Walter's earnings approach, Gordon's dividend discount model, free cash flow model, or your chop shop approach, EBITDA, earnings, God knows no which method. Some method they calculated and they told me. Now, proportionate net asset, how do I calculate now? What is my net assets? 750 into 20%. That comes to 150. This is called a proportionate net asset. How much it comes to? 980, 950. Minus FVNA, which is going to be same under both the scenario. So in the first case, my goodwill is 230. Second case, my goodwill is 200. That's why the first method, I call it full, the system standard calls it full goodwill method, because there are, when you pass the goodwill entry, there are two portions to it. One is belonging to the parent. How much? 200. 200, no? One is belonging to NCI. How much? 30. In this proportionate, it's called a partial goodwill method. There is only one person shares. Who is this? Parent. How much? 200. Can you alternatively calculate parent's share of goodwill? Very simple. See, how much you procured? 800 at 80%, correct? Minus, take out your share of assets. No. Why you are minusing 100%? Take, what is your share of assets? 80% of 750, how much? 600? 600. How much goodwill you got? That's your goodwill. So, this goodwill and this goodwill will always match. A proportionate net asset goodwill, and alternately you could have done this like this also. It will always match. Whatever you paid, you minus 80% of the asset only. Why you are minusing 100% of the asset? If you minus 100% of the asset, then together you need to have 100% of the equity there. Understood this? Now you understood why it is called a full goodwill method? Because this goodwill has got two components, parent and NCI. Because NCI you did the valuation based on the market price, which was not equal to its fair value of the net assets. Now the implication of this is, tomorrow if you do impairment of the goodwill, first question you should ask which method of goodwill valuation you followed. If you have followed full goodwill method, you have to distribute the impairment to two people. If you followed partial goodwill method, you have to do something called a grossing up, and then you have to give the share only to the parent. Have you understood now? Anyhow, we will do this immediately after this. We will do the impairment, then we will come to the consolidation. So that one element you understand it. Otherwise, impairment I need not do it at this point of time. So, accounting entry not required. They simply asked you, what would have been my journal entry? Fair value of assets, goodwill to investments to NCI. And if I have followed the partial goodwill method, fair value, goodwill, investment to NCI. So, only difference is the balancing figure is going to change. Are you clear now? Yes. So, we will move to the next question. This is anyhow, leave it. This is just example for you to understand. Sita acquires Geeta by purchasing 70% of the stake for 15 lakhs rupees in cash. The fair value of the NCI is 6.9 lakhs. Okay, when you see such statement, you have to make an assumption that the entity has opted for full goodwill method or fair value method. Management has elected to adopt full goodwill. They need not tell you also, but here they said very specifically, and NCI is measured at a fair value. That's what that information you should be carefully watching, because if you miss this information, your goodwill calculation will go for a toss. Instead of getting full marks, you will get marks only for step marks, purchase consideration and all. The net aggregate value of the identifiable assets and measures to be 22 lakhs, and they said tax consequence, please ignore. Time being, later we are going to get now, because deferred tax impact is also going to come into picture. Now, what is the gain on bargain purchase? Oh, straight away, that means this time I will not be getting, I don't think so, we will be getting goodwill. Goodwill is when your asset purchase is more, purchase consideration more than the net assets. But if your net assets are more than purchase consideration, definitely that will result into bargain gain, no? Okay, so write solution. Purchase consideration, how much? You can write heading rupees in lakhs. 15. Add NCI at fair value. How much? 6.9 minus FVNE 22. So I have got 0.10. Am I supposed to write any theory here? No, because the verb used is calculate. Otherwise, see, students, understand, always remember, whenever you are going to get a gain on bargain purchase, you have to write one theory. The theory goes like something like this. What accounting entry I should pass? Chalo, forget it. I'll ask you one thing. Can you tell me the journal entry? Net asset account debit 22. To cash 15. To NCI 6.9. Now tell me, what do you do with this 0.1? Where should you take? The standard says you have to take it to OCI. You should not take it to P&L account. But now standard says before you take to OCI, you have to revalidate all the values, because generally it is a surprise that you have acquired a business at a gain, because nobody will sell their business at a loss to you unless it is a distress sale. Then if you are sure definitely you made a gain because it is a distress sale, then you can take to OCI. In case you don't have any evidence, how did you get this profit? Then you have to take directly to other equity. P&L, so this will never come. Which one? That's what you will take to, means this year's P&L account, P&L statement of profit and, see, when I say statement of profit and loss, after P&L OCI statement comes, no. In this year's OCI, this will be reflected. If you don't have any evidence, then this year's statement it will not reflect. Straight away it will sit in your capital reserve. Otherwise it will come in this year's statement, and from there it will move to capital reserve. Followed, no? This is the theory you have to write. You will see that. One theory, always you have to write. Question number 7. Sita acquires Geeta by 70%. 6.9 is the fair value. Net assets is 22. I think it's the same question. No, I think you may have to calculate using proportionate net asset method. Yeah, they said no. They may fool you. Institute may fool you in the examination. Don't always go with the fair value is determined to be 6.9 means you will take the fair value method. Read management adopted partial goodwill method. Okay, please tell me the goodwill amount. Goodwill or gain on bargain purchase. Yes, students, please pause it and work it out. And besides this, question number 7, 8 and 9 also, please calculate the goodwill and keep it ready with you. You can use the calculator also. Yes, students. So we'll compare the answers. So you have got proportionate net asset method. So NCA will be 30% of your 22 lakhs. So you got 0.04 gain on bargain purchase. Next question. X Limited acquired Y on payment of 25 crores, transferring a retail business, the fair value of which is 15 crores. You remember one place, purchase consideration includes your non-cash items also. In my format, we were discussing, purchase consideration can have cash, can have shares, deferred consideration, contingent consideration, non-cash consideration. It's like a non-cash. Like you acquired patent and equipment by using cash and land. Assets acquired and liabilities assumed are 36 lakhs. That this is what you acquired. What is your goodwill here? Did you calculate this goodwill? 4. How? So purchase consideration 25 plus 15. Non-cash consideration should be taken at its fair value. Assets given up. NCI not there. Fair value of previously held equity is not there. 100% net assets is 36. You will have a goodwill of 4. Any confusion was there here? This is the only one place where they have come across this. None of the places non-cash consideration has been given. That's why just keep in mind, if they give you, this is the way you have to account it. Sorry, fair value of the business. We are paying cash plus our whatever that land or something. I can do anything, no? Now what happened? Any confusion? And transferring a retail business. That means I have got one retail business here. Okay? There's one subsidiary in, like you remember that in PP we discussed about the what that's called exchange of warehouse. So I might have purchased somebody's property by giving cash and giving up my retail business to them. Take this retail business, one retail storeroom. And transferring a retail business, the fair value of which is 15. That means whatever business you gave to them, its business value is 15. Oh, how did you read it? No, and they said transferring a retail business, no? You thought it is acquiring business. No, it is our business. It is a non-cash consideration. That's what I am telling you. There is only one question where you find this non-cash consideration. Otherwise, none of the places you come across. Raja purchased 60% by paying 525 lakhs. Number of issued capital of RAM is 1 lakh. Fair value of the identified assets is 640 and liabilities 50. So we have to do net of 640 minus 50. Market price is 775. What is the fair value of the goodwill? What is the value of the goodwill? Which method to adopt? See now, if the question is I would have adopted partial goodwill method. But why on earth they should give me the market price of RAM? What is the relevance of this? They want me to follow the fair value method. Why? See, they give me number of shares also. If I take 60% them, 40% must be NCI multiplied by 775 gives me this. So fair value method is followed. So NCI will be 1 lakh into 40% into 775. So I hope with this different calculations you understood on what all things they may give you in the examination question. In fact, it is a very simple thing. Either fair value method or proportionate net asset method you need to follow. But they may give you number of shares, they may give you the valuation technique, this is the value, they may give you the value, they may ask you to calculate the proportionate net assets. All these things they will do, so be careful. None of the questions I can say it can appear for examination till now, it is only for our understanding. Next question is a probable examination question. Classic Limited acquired ordinary shares of Natural Limited, a private entity, for 97.5 crores. How much? 60%. Identified net fair value is 150. 40% of the ordinary shares of NCI is 65 crores. Carrying amount of natural limited net assets is 120 crores. What I have to do with this carrying amount of the natural limit? I don't need this information. I am interested in fair value of the net assets. How will the NCI will be measured? Theory question or practical question? These are theory plus practical. I don't know what they may, so please mark this question important. If they ask you how it is measured, you have to explain the theory. Okay, right? As per 103. NCI representing ownership interest means equity share. NCI representing equity shares shall be valued, in bracket you can write option, at fair value or proportionate net assets. So you say that as per 103, NCI which represents the interest in the ownership can be valued at the option of the acquirer at fair value or proportionate interest method. Other NCI, other component of NCI is measured at fair value only. There is no option available. That means if it was a preference shares, you would have valued at fair value. Since it is an equity share, you got an option to value the equity interest either fair value or proportionate. If there were preference shares which you are not holding, possible? No. Acquirees preference shares, you must be holding it. That is your interest. And which you don't hold, that you have to value at a fair value. There is no option of proportionate net asset. Why? Because those people, preference shareholders, are not entitled for proportionate net asset. That's why you don't value them proportionate net asset. Only equity owners are entitled to the proportionate net asset. So this way you measure the values. Write goodwill calculation, working note 1. Goodwill calculation, fair value method, proportionate net asset method. Purchase consideration is how much? Okay, which is not going to change. Simple, no? Business combination. NCI will be 65 if you follow fair value method, then 150 into 40% if you follow proportionate net asset method, minus FVNA 150 in both the cases. So you are going to get 12.5 full goodwill method, 7.5 partial goodwill method. This is your goodwill because your purchase consideration is more than the net assets. So first you said explain how it is measured. It can be, there is an option. You gave one calculations, followed? Then you have to pass the journal entry, but before passing that journal entry you have to tell about these options. So option 1, right? That's what I am telling. This can be an examination question. Option 1, NCI at fair value. Here goodwill represent difference between fair value of natural limited, because purchase consideration what you would have paid, it is at a fair value of the business, plus valuation of NCA is also at a fair value of the business. That means 100% business value and fair value of net assets. That means you would have, when you follow full goodwill method, you would have taken the business value as a whole minus the individual assets net asset. So below journal entry will be passing F fair value of net asset account debit 150, goodwill debit 12.5, to investment or cash 97.5, to NCI 65. See, certain questions we have to mark it important. It's not simple calculations for you. You will end up losing 1 or 2 marks for not writing, telling these things. Option 2, I can proceed further. Done. Option 2, can you tell me, students, now under this method, under proportionate net asset method, goodwill represent difference between, can you tell me what is the goodwill? You say purchase consideration and the fair value of acquirer's share of net asset. You remember first I told you, no, one goodwill is you will include NCA also minus 100% of the fair value. Alternatively, so you paid 750 for say 80%, minus you take 80% of your net assets. So in the proportionate net asset method, the goodwill represents the difference between the purchase consideration given and acquirer's share of fair value of the net assets. So what is my journal entry? FVNA debit 150, goodwill 7.5, to investment 97.5, to NCI at 60, because you have measured NCI at a proportionate net assets, no? 97.5. 50 into how much? This 97.5 for how much percentage of investment? 60%. So can you calculate 150 into 60% minus 97.5? You get the same. That's what you are trying to tell here. Look, there are two ways of calculating the goodwill, or two ways to measure the NCI. In this measurement, NCI is always measured at the proportionate net asset only. So there is no question of goodwill allocated to NCI here. So have you understood very clearly the two methods of valuation? One thing. Have you understood in the examination how to write? Second thing. Both are important to play test, because plug and play is going to happen somewhere. So you should know, okay, this theory, how you should write it, plug it, do this calculation, present it this way. See, objective is to score full out of full, but no, at least maximum. Follow? Yes. Question number 11. Company acquired 90% of the equity interest for a consideration of 85 crores in a distressed sale. Okay. This time you have to write the theory of that distressed sale. Company B did not have any instrument recognized in equity. Company B did not have any instrument recognized in equity. The company appointed a register valuer whose assistance the company valued the fair value of the NCI and assets to be 15 and 100 crores. What is the value at which NCI has to be shown in the financial statement? Okay, this is not an examination question. Tell me what is the value at which it should be shown. You say again there are two options. Okay, one option is to show at a proportion net asset. Another value is to show at a 15 crores fair value. Okay, so See, again, purpose of solving this question is, they may give you some story like this. You called one registered valuer. Valuer told that value of the NCA is so much. They did not have any instrument recognized in equity. That means previously you did not invest anything. So that means whatever 10% is there, it is your NCI only. It is a distress sale. But the question is very silent about calculation of the goodwill. They simply ask your NCI only. No. Because you don't find a company where you don't have any equity. No. Leave it. No, it's a confusing statement. May not be existing in the examination. We are not clear. Some statement is added which is not complete. Worst case, it may come in the examination. Strategy, dump whatever is there in the study material. We can assume it like this. We can say that company B did not have any instrument recognized in equity. Maybe company A they mean to say. Previously, we can try to interpret it like this. Previously, you didn't had anything. That means there is no step acquisition. It is 100% acquisition, right? But if you try to give any other meaning, no, you end up being confused in the examination hall, which you cannot afford. See what makes sense to you. Take a judgment and proceed further. No. Hardly how many marks this may come for? Worst case scenario, 4 marks. Take a judgment, proceed further. Okay, right. Okay, we'll write. There is nothing much to write. Option 1. NCI at fair value is equal to rupees 15 crore. Option 2, NCI at proportion net asset is equal to 100 into 10%, 10 crore. Yeah, just write 2 lines. Yes, so we'll proceed further. On 1st of January, you acquired 80%, A Limited acquired 80% of B. Former owners of B were required to dispose of their investment by the specified date. That's why they did not have got much time to negotiate. See, these sentences in your examination question indicates that it must be a bargain gain. Distress sale. A qualified valuer professional appointed by management of A Limited measures the identifiable assets as per 103 at 20 and fair value of 20% NCI at 4.2. How should A recognize the bargain gain? Okay, right? Calculation of the bargain gain. No fun, no here. Simple questions. Yeah, one component should, and it's sure shot. See, don't lose your heart. Even balance sheet doesn't tally for some reason. For 1 mark you will get no in examination. NCA calculation, sure shot you will get 1 mark provided you do it correctly. Don't mess with it. So FV PNA purchase consideration is 15, NCI 4.2 and a fair value method 20 into 20%, 4 under net asset method. Okay, you tell me, what is your purchase consideration? What is your NCI under fair value? Have they told you or are we supposed to calculate? Under fair value, it's given. How much? 4.2. They said no, they called one valuer. Valuer did the method valuation. What is my NCI under proportion and net assets? This is always I am supposed to calculate. For this, what I should look for first? Fair value of the net assets. How much is the net assets? 20. 20% is my NCI stake. So that comes to 4. Minus, what is my fair value of the net assets? 20. So I end up getting a gain on purchase 0.8 and 1. Yes. Yeah, please ask me now. Where NCI has got? Okay, your point is gain on the bargain purchase only. Yeah, but you have taken an option to value them at a market price, no? See, their valuation is more than, is less than what assets you are attributing to them. It's an opposite of goodwill, no? When you value them, their valuations are more than the net assets. That is why you call them goodwill. In fact, yeah, they don't get anything in both the cases. Okay, same question I can ask. No, if when you do valuation of the goodwill, they may shout, no? In fact, they don't have any relevance. They say in your books, whatever you want to show, please show for me what. They don't get anything. For them, what is relevant is equity method of accounting, which is followed as per Ind AS 28. It is not. It is what your standard permits you. Followed, no? And if you ask me, 99% of the cases are goodwill. This is rare. It generally doesn't happen. That's why we have to write one theory, recognition of the bargain purchase. Okay, so there is some theory. Okay, I'll just tell you, if while practicing you can practice. You say that if NCI is measured at a fair value, you will have a gain of 0.8. If NCI is measured at a net asset, you will have a gain of 1. You explain the same thing. But a very important theory is this. Thus, a company A, see, you got a bargain gain now. So you have to write one theory. Shall review the procedures used to identify the fair value of net assets and NCI. So when you get this, suppose suddenly you get one unreasonable thing. Like suppose you thought that you have to pay tax. Suddenly you see that you got a refund. You got a surprise. What you do? Recheck, no? Because as per your guess, tax payable should have come. You get surprise. So you think, did I made a mistake somewhere? That's why the standard says you have to review whenever you get a business gain, you have to review how did you identify the fair value. Was there any mistake happened there? How did you calculate NCI? Did any mistake happen there? Specific consideration be given for transaction not part of business consideration. Did you pay anything to the owner and by mistake you included in the purchase consideration? Owner employee. Did you reimburse them acquisition cost which was not supposed to be here? Was there any settlement of pre-existing relationship which should have been separately accounted but by mistake I have included in the purchase consideration? See, all these things may happen, something like that. Okay, generally it will result into goodwill. It will give you goodwill, but some mistakes like that, similar to anything like fair valuation assets and all, you have to check. Or ulta, I have receivable, like we have seen progressive, regressive, where regressive filed a complaint. Now what if I would have filed a complaint? So post review, if there exists reason for bargain gain, A Limited can recognize it in OCI and where to take in balance sheet, accumulate in capital reserve. So whenever you get bargain purchase, see whether they will ask you theory. I will explain this. The company A shall review the procedures used to identify the fair value of net assets and NCI. Specific consideration should be given for transactions which are not part of the business consideration. And after the review, if there exists a strong reason that yes, there is a bargain purchase, A Limited should recognize that bargain gain in OCI. And where to keep? Should I keep a separate new column there? No. Accumulate in capital reserve. You must be having some capital reserve. Go and add there. If you don't find any strong reason, straight away take to the capital reserve and add it. Don't add it in this year's OCI. Are you clear? Yes. Question number 13. It's clear now? So again, my point to show you in this question, one particular theory. See, 2-3 theories we have learnt when they ask me to write the theory. Otherwise, it's the same simple calculation. Company A acquired 70% of S, consideration transferred of 5 million. They intend to recognize NCI at a fair value, proportionate net asset. With the assistance of a qualified professional, they measure their assets value to be 10 million. A performs a review and determines that the business combination did not include any transaction that should be accounted separately from the business combination. By this sentence, you get a sense that there must be some gain. Otherwise, why they should tell? They had a review, they have determined and all. State whether the procedure followed by A and the resulting measurements are appropriate or not. And also calculate the gain on bargain purchase. First, they should have told you, calculate this gain. This is what they should have told you first. And then state what did they do? They must have taken it to OCI. Is that correct? See, when you calculate, okay, first tell me, do the working note 1, not working note 1, calculation of gain. Calculation of gain on bargain purchase. Let us do it step by step. Calculation of gain. So can you tell me the gain? Students, please pause the video and tell me the gain. Yes, students. So we'll check the answers. You got a gain of 2 millions. 50 plus 30, which is 10 million into 30%, minus 1 crore. You got 20 lakhs. Now what did they do with this 20 million? 2 million, what they must have done? Now read the first part of the question. State whether the procedure followed by A and resulting measurements are appropriate or not. They must have transferred it to OCI. Can they transfer to OCI? When? Question is not clear. See, first of all, they acquired one. Okay, since the concept is not clear, does it sound like an examination question? Correct? Confusing question, no? Okay, what they're asking you, they acquired, company A acquired company S, and they say calculate the gain on bargain purchase. How many marks? 2 marks. Then with the assistance of a professional, they measured the identifiable net assets to be 10 million. That means arbitrarily they didn't get, they appointed a qualified valuer. And they performed a review and determined that the business combination did not include any transaction that should be accounted separately from the business combination. That means what they must have done, when they calculated the gain on bargain purchase, they got a gain. They must have transferred it to OCI and then they took to capital reserve. Now you need to state whether that was correct. Yes, they could have done that only after they could have done one review. What review? Whether calculations are perfect. Is there any transaction which is not part of the business combination? And have they done it? Yes. This sentence states that the entity A has done those activities. They have done no. If they would not have done that, you should have made an assumption, assuming if they would do this, they can take to OCI. And if they have not done it, they have to take directly to the capital reserve. This should be your answer. If you have got a very strong reason that really you negotiated well. See, gain comes when you get something like one mobile is there, 20,000 rupees. You are a very fantastic negotiator. You negotiated for 15,000 rupees. Is it a gain? It's a gain. How did you get this? Because you figured out one guy who was desperate to sell. It was your efforts. Simply you didn't get. The standard doesn't permit it in OCI, P&L, because it's a capital gains. No? It's like a capital income, right? So the standard says you can't take to P&L, straight away take to the balance sheet. Because it is not operational, no? Is it your operational income? Not an operational income. So now you negotiated it. Now if because of your efforts, if you really negotiated it well, you take to that year's OCI and then take to the balance sheet. If you are not sure how come you got on earth that mobile 20,000 worth for 15,000, can you repeat that? No. Then don't feel proud and show in the OCI that look, I got this gain. Take directly to the balance sheet. This is the underlying theory behind what we are trying to do there. So if that gain has come really because of your efforts, because of your negotiation skills, then take to the OCI. If you are not sure why you got the gain, it can be a calculation mistake also. Please go and review. You see, every calculations are perfect. It says, so you are clear, no? This sentence, that means you have to review again. Is there anything else? Now, you must have got a mobile at a discount of 15%. Probably he may not have given you warranty there. That means your negotiations are defective. So this is what you need to review. Followed, no? So you calculated the gain and you have to write one theory. Company shall review, A Limited shall review procedures. Enough, no? We have written in detail last time of measurement. If there is evidence, take to OCI.
Dear students,
are you clear? Okay, this part is clear, no? See, and this is what theory will write, that NCI is measured at a fair value. Thus, they need to review the procedures and give the special consideration for the transactions which are not part of the business combination. And if they get the strong evidence that there is a really negotiation and all those things, take to OCI and then accumulate in the capital reserve. So in the given case, if you want, you can write in the given case, they have done it, so their procedures are correct. So now, since there is a confusion in this question, can you see this question appeared in the examination? Moon Limited acquired 75%, consideration transferred is 60 lakhs, intend to recognize at fair value of the identifiable assets, proportionate asset. With the assistance, they appointed and measured the fair value to be 90 lakhs. They perform a review and determine that the business combination did not include any transaction that should be accounted separately from business combination. State whether the procedures and resulting measurements are appropriate and also calculate the gain in the process. 4-mark question. See, in these 4 marks, probably 2 marks for the calculation and 2 marks for that 2 theories, which you need to tell that, look, this is fine, you have to review and you have to do this. And that theory comes only for OCI, that bargain gain. So we can proceed further, no? There is nothing here. Yes, students, if you want, you can pause the video and work out. So you can note down the number. The goodwill comes to, gain on bargain purchase comes to 7.5 lakhs. 60 lakhs is the purchase consideration. 90 lakhs into 25% is your NCI, fair value 90 lakhs. So review procedures, you say that it should be measured, you should check the procedures, check specific considerations and check if every evidence is there, take to OCI and then accumulate in the capital. Sorry, I didn't get it. Which method? See, in real life you are talking or here? See, here what happened, no? We have to just go with the questions, what they tell me. If they tell me that the fair value they appointed and this thing, they will give the market number of shares, market price and all, we can give top priority to the fair valuation method. Question is very silent, by default we will go to proportionate because that is the default option. Followed, no? So generally outside again, it goes to the company to company. Okay, what they want to present, it goes with the transaction to transaction. It's not that you have to choose every business combination, you have to follow one method. This is applied transaction. That means one business combination I can do and see at fair value. I will apply one, I will acquire one listed entity. I will straight away go for fair value capture. I will apply one non-listed company. I will go with the proportionate net asset method because fair value may not be ascertainable in that case. Clear, no? Yes, October 2011, IHL acquired 75% of very relevant limited by paying cash of 0.8 million. Fair value of the NCI is 20%, 0.2 million. The value of very relevant limited identifiable assets is 1.1. Determine the value of the gain on bargain purchase. It is measured at a fair value NCI. Okay, please pause the video and tell me the numbers. Yes. So you must have got this number. Gain on bargain purchase is 0.1 versus 0.025, which is purchase consideration. Same. NCI will be at 0.275. They have given this value minus 1. And that's it. Okay, two RTP questions we'll see with little difference. On 1st of April, Alpha acquired 80% of equity interest in Beta for exchange of cash of 300, but you acquired only 80%. Due to legal compulsion, they have to dispose of the investment by a specified date. Therefore, they did not have sufficient time. So, somewhere you understood that you will end up with the bargain gain with these sentences. The management initially measures separately recognized identified assets and liabilities in accordance with the requirement of 103 English. Identifiable net assets are 500 and liabilities are 400. So, net is 400. This is what I wanted. So many big language there. Alpha engages independent consultant who determines the fair value of the 20% NCI is 84. Fair value method, full goodwill method. Alpha reviewed the procedure it used to identify and measure the assets acquired, liability assumed, and consideration transferred. So it decided that the procedures are very appropriate. Again, you understood, okay, it's the same exam question. Now calculate the gain or loss on the acquisition and also show journal entries for accounting of acquisition. So first of all, you need to calculate the gain or loss. Second, give the journal entry. Also calculate the value of NCI on the basis of proportionate net method if alternative is applied. Please pause the video and do this. Theory is required? Not required. Okay, so first thing, see, they didn't ask any theory here, whether their procedures are appropriate. Clean, they asked me calculate and show the journal entry. So first I will say purchase consideration is 300, NCI is 84 at a fair value, and I have got 16 as the gain on bargain purchase. Did you get this? Next acquisition entry, they asked me assets 500, liabilities, cash, NCI, gain on bargain purchase. If you want, you can write one small note, assume to be the review procedures are correct or evidence exists for bargain purchase, because question from top to bottom it is explaining everything, that there was a distress sale, they did all the review, why I should assume. So I'll straight away take to OCI. Any mistakes? What happened? You took a net 400. Okay, learning maybe. They may deduct marks for that because one learning, yeah, good. That somewhere may make a mistake because they said specifically, see, from a calculation point of view, you could have clubbed it together, but when it comes to journal entry, you cannot club, no. Because if they would have asked you balance sheet, you would have shown net assets there. No, you would have shown assets and liabilities separately. Yes, good. Learning there. These two things. Then if it is the proportionate net assets, then it is 20. Did you get this 20? Again, institute looks for ways to cut your marks somewhere. Not, they don't want to give 5 out of 5. One small mistake, they know exactly and where people will make mistake also. Yes, students, done? Yeah, that's why I'm telling you, please share your mistakes with me. For me also, see, it's a new understanding. I have never discussed it prior because nobody told me. So when you make mistakes, no, tell me so that, yes, others also understand that these things could be possible. These are the things we have to take care. Now, Bima acquired 65% of NAFA, engaged in the production of components of machinery. They have got 1 lakh equity shares of 10. The market price is 12. Fair value of the identifiable assets is 80 lakhs. Bima wired 50 lakhs in cash, means paid. Issued 50,000 shares as a purchase consideration. The quoted market price of Bima is 25 per share. Bima also agreed to pay additional consideration of 15 lakhs if the cumulative profits earned by NAFA exceeded 1 crore over next 3 years. On the date of acquisition, it is assessed to be determined, consideration is probable and extra consideration will be paid and its fair value is 9.8 lakhs. NAFA incurred 1,50,000 in relation to direct acquisition cost. It measures NCI at a fair value. They need not tell me, we have made an assumption also. Now, how would you account the acquisition cost? Prepare the detailed working and pass the entries. Can you do this? And if you look into this, what is the crux of this question? Purchase consideration. That's why first prepare one working note for purchase consideration, goodwill, and then pass the journal entry. Any doubts we have in this question? So if you have doubts, take decision and then solve the problem. Let us compare. Now I wish you made some mistakes. Okay. First of all, we have to calculate the purchase consideration. So first component is the share exchange. It will go to 12,50,000. See, whose price I need to consider? Who issued shares to whom? Who is the purchaser here? Acquirer. Bima is the acquirer. Bima issued its share to the shareholders of NAFA. So my share is valued with my price, no, not NAFA's price. But when you value NCI, NAFA's NCI should be valued with NAFA's price. Followed, no? Yeah, mistakes are welcome. So 12,50,000, because see, one small mistake is going to change everything. Cash consideration 50, contingent consideration 9.8. Now question one more comes, that acquisition cost. What does the question says? NAFA paid. Have these people reimbursed? No. That's left to your choice. If you assume it is reimbursed, will you add or will you deduct? You should deduct, no, from the purchase consideration, because when you paid cash, entire 50 lakhs you didn't pay for the business acquisition. 50 lakh has got two breakup there. 49 lakhs is for the assets. No. Who incurred? Exactly, who incurred? NAFA, acquiree. Now purchase consideration we are calculating from whose perspective? Bima. So did the Bima pay that cash? No, it has nowhere related to. Did I pay anything to the owners for the assets? See, this is my payment for acquiring 100% of the asset. Now somebody incurred some cost of due diligence, which Bima was not asked to reimburse. So why it should come in my calculation? Alternatively, if you make an assumption, whatever NAFA incurred, Bima, because question is very silent there, Bima reimbursed. In such case, what happened, no? That payment of 50 lakhs include that 1 lakh also. And this 1 lakh, is it for the business combination? No, it is direct expenditure. So you have to minus that direct acquisition cost, which is reimbursed. That's why if you see, yesterday I was telling, if it is included in the consideration, if it is included, then only you should deduct it. Agreed. I'm not, not to be added. Who incurred this cost? NAFA. So what account, will he pass any account? What accounting entry NAFA will pass? Bank credit to is not his expense, no. His be my account debit to this thing. Okay. Now, who will pay him? I will pay him. Okay, when I paid him, did I pay to owners or did I pay to NAFA? NAFA, no. What is purchase consideration? Purchase consideration is what you pay to the owners. Follow? So, when you paid 50, you instructed owners, sir, out of 50, 1 lakh I am supposed to pay to NAFA, you please pay them. Then NAFA will pass one more entry, share capital account debit to Bima. They will close Bima's account because owners have to pay them now. Because I paid this reimbursement cost to the owner. It's like you incurred some cost, I paid to your parent. Am I any more responsible? No. Who is supposed to pay you now? Your parents will pay because I settled from my side. So if you make an assumption, it is part, then you have to minus the transaction cost. Second, goodwill calculation. If it is reimbursed, if specifically they tell, or if you take an assumption. Nothing. If they incurred, leave it them. What if they would have incurred, Bima directly incurred? Nothing. It was separate. It has nothing to do with the purchase consideration. Only if they come across reimbursement, then you have to deduct it from the purchase consideration. So total consideration will be 72.3. Add NCI at fair value 1 lakh into 35% into 12. Because this time you have to take 12 only. Because you are valuing NCI is NAFA. And fair value of the 100% of the asset is 80. So you get bargain purchase 3.5. So your accounting entry in the business acquisition cost, you should write a note. 1.5 are expensed in the period in which they are incurred and not part of the consideration transfer. It should not be part. Yeah, this is your asset. No, see, if shortcut method you want to calculate the goodwill, you can do that. But here though you cannot do, no, because you have to, they specifically said, see, you can take that only when you follow partial goodwill method. In full goodwill method, this has got two components because you followed a full goodwill, no, fair value method. So you can never take 90% of this asset. Always in every single question, the presentation should be like this. Which method of goodwill valuation they agreed to follow? Has they told you anything? They told at the last, I think they must have told one sentence. Did you miss that sentence? They adopted a fair value method. Did you miss that sentence? That means follow the full goodwill method. That is why I am trying to do so many questions. No, even though it is boring from morning, even though it is boring, no? For me, it is a very boring thing from morning calculation of the goodwill. Why I am doing so many things? Because I am showing you so many languages in which they may tell you, follow which method. Means fair value method. That means this method you cannot take 80 lakhs into whatever that 10%. Proportionate method you cannot use. That's why don't get into that. You understand which method of follow and always take 100% of the assets here at the bottom. Follow, no? And see the different languages. So they may give you fair value and at the bottom they may say they adopted proportionate net asset method. Gone, no. Simply lost your marks, no. Didn't knew? You knew it. Why you lost? Because of your carelessness, which is not acceptable. You didn't knew, okay, somewhere some excuse is there. But you have seen there, you know it. I don't want you to lose that. Conceptually, they may trick you. That is different story. Followed? Yeah. Any doubts you have? Misguiding. It cannot. It's actually misguided word in this NAFA didn't incur, because if you see the solution, no, they say acquisition cost should not be part of the consideration. That means who must have incurred? BMO must have incurred. But in the question, they simply told NAFA incurred. Leave it. This is all the tricks they follow. And I wish more than discussing these things in the classroom, rather than me solving, you repeat it. I want you to open up and ask me so many questions. What may happen? What is the possibilities? Yeah, acquisition cost to P&L, it should go to P&L. P&L account debit to acquisition cost. Sorry, normal? Any name you forget, no? You just tell P&L, acquisition cost, in bracket you can write P&L. So your accounting entry will be identified net assets, equity share capital. Have they given you the face value of assumed? Okay. 5 lakhs. Share premium, balance amount will go to share premium. NCA, because 25 cannot be your face value, no. They said mark, they have given, no. Then again you can. Bima they have not given. Then you have to make an assumption. NAFA's face value you cannot consider here, no. What if NAFA's face value, Bima's face value is 100 rupees? Yeah, learning. Followed, no? And if you don't do this, see, please expect that the market will be deducted. Because you cannot show equity share capital at 25 there, when they specifically said market price. If they don't tell market price, then you cannot have taken that assumption. NCI, contingent liability consideration, you can call it liability. Why? Because it's a cash payment to NCI 4.2 at a fair value, cash payment to bargain OCI, in bracket OCI. And we assume that there is a sufficient evidence for that, which question itself says. Otherwise, if the question is silent, you make a write OCI and write, it's assumed that there is a strong evidence for the OCI. Then see, even though they want to try to deduct their mark, no, they will not be able to deduct. See, that much strict they won't go. The way I am telling you, oh, one face value they'll cut the mark and all. But why do you want to take a chance? When you practice it very clear-minded, no? You need to have that clarity. Nice question, but right? So we got somewhere one flavor of one business combination question, how it will look like, a small miniature question with the different components. Next, can I proceed further? I can proceed further. Understood, no? Everything you understood, no? Every aspect of adjustments. Okay, don't leave it anything pending. Now we will come to the deferred tax adjustment for the net assets. Okay, see the last aspect in the goodwill calculation. So already we have understood the NCI, purchase consideration, and the previously held equity. The last leg is pending, called a fair value of the net assets. Now, when we talk about the fair value of the net assets, you see, in every question they would have told me the fair value of the assets, because I cannot simply sit and assume there. Is there any calculations involved? Yes, there can be certain calculations involved in deferred tax, which we already completed in Ind AS 12. But there can be two more elements called contingent liability and indemnification asset. And they say that all the assets should be measured at a fair value. What is the story about the contingent liability? Understand. Ind AS 37, which you are yet to do, it defines a contingent liability as a possible obligation because of the past events whose existence is confirmed by the uncertain events which is not within your control. Like you have slapped someone, they filed a complaint against you, the matter is pending in a court. Because of this, there can be a possible obligation. Why? Because of the past event you slapped, and it is uncertain and it is not within your control. It is depending upon a judge now. Or it is a present obligation that is also coming because of the past. That means right now I am supposed to pay But why I didn't recognize it? Because it is not probable. That means less than 50% chance. And outflow of economic resources, or I cannot measure it. That means right now I am supposed to pay, but I don't know how much I need to pay. Or right now I need to pay, but the probability of payment is less than 50%. If the probability of payment is more than 50%, I will make a provision. So this is the definition of contingent liability. Now there is one exception for Ind AS 37 when it comes to contingent liability in a business combination. Acquirer shall recognize the contingent liability. That means you can make a provision for contingent liability. The moment you make a provision for contingent liability, another leg will sit in the goodwill. Otherwise, any time when you recognize a liability, either asset should come or expense should come. Anytime when you credit liability, debit what? Either asset or expense, as per our accounting equation. Now, when you contingent liabilities, you don't pass an entry only, but the standard says you can pass a credit to contingent liability, but since you don't have anything debit to goodwill. Now, when it is a present obligation and you can measure fair value reliably, that means what is this not probable? No, this exception goes. I'll give you one summary so that you can understand. See, something is possible, not present. It may happen in the future. Then probability, you don't think about it. Can you measure reliably? Don't think about it. It is contingent liability in both the cases. Something is present now and probable. You cannot measure contingent liability. It's a contingent liability. Something right now you have to pay, but you cannot measure it. Whether it is a business combination or whether it is a normal business, it is a contingent liability only. Something is present and probable. You can measure, then you have to make a provision under both the cases. Present and probable, more than 50%. You have to make a provision. Present, not probable, less than 50%. But you cannot measure, then it is a contingent. See, certain things you cannot measure, contingent liability, even though it is present. But the last thing is present, less than 50%. Generally, in our normal day-to-day life, we don't make any provisions. We show it as a contingent liability. But for this category, it will say you have to make a provision as per 103. That's it. One exception. Present, less than 50%, but you will pass journal. If the same situation would have appeared in our day-to-day life, you would have shown it as a contingent liability. Because it is not probable. It is less than 50%. Now, the moment contingent liability comes, there is one more asset comes called an indemnification asset. What is the concept of indemnification? A seller of a business contractually indemnify the acquirer for outcome of a contingency. Thus, you obtain an indemnification asset. Say, for example, it may go like this. P Limited acquires S Limited from its owners. Now, S Limited, somebody has already filed a complaint that S Limited is one hospitality or hotel, somebody ate the food there and some food poisoning happened, health got some damaged and all, whatever it is. They filed a complaint against S Limited. Now, on the date of acquisition, that case was pending. Will you recognize this contingent liability and pass the journal entry in our business books? They didn't do it. Why? Because it is not probable. Will you do it? Yes. Why? Because there is one exception. Now, the moment one contingent liability comes into your business, you end up paying less money to the owners, no? Because their balance sheet doesn't include this liability. So their net assets are more. They say, give me more money. What I will say, sir, look, outside there is balance sheet, there is one contingent liability. It may become, so I will not pay you. But they say, sir, this is a contingent liability. No, this is not a liability for me. It is not even probable. But I say, look, I don't know. Then do one thing. If you want me to pay you the net asset, give me a guarantee. Give me a guarantee that tomorrow, if that item which I left out from the business valuation, if tomorrow, if it happens, you have to reimburse me that. If who has to, that's the catch here. The owners, because whom you paid the consideration, them, no. And tomorrow, if compensation has to pay, who has to pay? Owners went, no, they are in Switzerland now. After selling, they are not there. Now S has to pay. And the S, no, who has filed a complaint against whom? One customer has filed a complaint against S. Now who is S? Who is whose child now? His child. That means my child has to pay. No. Previously, his child had to pay. Do you bother? No. But after you take over from him, if this amount has to be paid, S is your child now. At a group level. At a group level, it is a loss for you. So that's why you tell these owners before going to Switzerland, you tell them, look, I will pay you full money, assuming it to be contingent liability. But tomorrow, if at all this liability comes back to me now, I don't know wherever you are, you have to give me one guarantee that you have to reimburse me. Understood who is giving to whom now contingent indemnification asset? That's what I'm telling. S doesn't come into picture here. Owners of the S, previous owners from whom you purchased, no, they give one guarantee to you. P or S, okay, whoever it is, doesn't matter. Because at a group level, because see, ultimately, indemnification asset comes at the standalone statement or a consolidated statement. Where? Standalone, who is guaranteeing who purchased who? You have made one investment. We are talking all these things from a consolidation perspective, understand? Why? Because at a consolidation level, P and S are one entity. In a standalone, indemnification asset doesn't come into picture only there. Because nobody acquired nobody there. In standalone, S is a standalone person there. And P has made one investment in S, that's it. At a consolidation, when you are one entity, you are going to incur a liability. There is one asset called indemnification asset which never exists in the balance sheet of S. Contingent liability also never exists. So both are out and out. So you have to recognize now. Have you understood this? So for example, seller will guarantee that liability of not so does not exceed. So accounting, you have to be careful. Acquirer shall recognize an indemnification asset. The same time it recognizes indemnification item. A liability, if you don't recognize, how can you recognize asset? Indemnification asset will be with respect to one contingent liability. So first you recognize that liability, and to that extent only you should recognize the asset. Indemnification asset cannot exceed liability. They may guarantee you more than the liability, but if you don't recognize that liability, you have to restrict to that asset only. And why? Because there is an exception for you to recognize the contingent liability. There is some theory, we will discuss that also. Okay, first we will discuss the theory. Then we will finish then and there. Indemnification asset related theory. ABC acquired a beverage company PQR. See, now you understand this very clearly. ABC acquired PQR from XYZ. Here there is a ABC, PQR. XYZ was the earlier parent. And at the time of acquisition, PQR is in the defendant in a court case where certain customers of PQR alleged that their product contained pesticides, some blah blah blah, some story. Somebody has filed a complaint. PQR is being sued for damages of 2 crore. XYZ has indemnified ABC. XYZ, the parent, have told ABC that any loss you incur up to 1 crore, we will pay you. Why? Because it's contingent, and the fair value of the liability is 70 lakhs. Today's day, its fair value is 70 lakhs. The probability of I may end up paying 2 crore is 70 lakhs. So how much I will recognize? 70 only. How much asset I should recognize? To the extent of 70 only. So how should ABC account for contingent liability and indemnification asset? And what if the fair value of the liability is 1.2? 1, exactly. Why? Because my asset itself 1 only, no. So you will say that ABC Limited measures identified liability at 70 lakhs because it is at a fair value. Corresponding asset, indemnification asset also at 70. Because of this, no impact on the goodwill. Why? Because your accounting entry will be indemnification asset account debit to contingent liability account. No impact on the goodwill. Alternatively, if the liability is more than that, you will restrict your asset only to 1 crore. So 20 lakhs will go to goodwill. This is for your understanding purpose. Perfect. One more question we'll say just for our understanding, because I have assigned some 2 marks, 4 marks and all. ABC pays 50 crores to acquire PQR from XYZ. They manufactured fiberglasses. 10 class cases were there. They agreed to compensate up to 10 crores. So, X number of cases were there. They will give 10 crores. The class actions have not specified the amount of damages, and the past claims suggest that it may come up to 1 crore each. Okay, 10 cases were there. Each of the case I may incur 1 crore. That's why somebody gave me a guarantee of 10 crores. ABC makes an assessment and decided to potentially outcome contingent liability cannot be measured reliably. Accordingly, no amount is recognized in the court cases. How you should account the indemnification asset? No, don't recognize. Why? Because contingent, see, first of all, to recognize the indemnification asset, contingent liability should have recognized. There is one exception which says that even though it is not probable, you can recognize, but you need to measure it reliably. But here it says very clearly that you cannot measure reliably, you cannot recognize liability. So you say that since no liability is recognized, you cannot recognize the asset also. Clear, Nagabhushan? Company A acquires B on 1st April. B is being sued by one of the customer for rupees 250. This is a new example they have updated in the new syllabus study material. Seller B provides indemnification. Sellers of B provides indemnification for reimbursement of up to 200. No collectability issues. At what value contingent liability and indemnification to be recognized? See, contingent liability you will recognize at 250. Indemnification asset, what did they say? So they may give the language like this: sellers provide indemnification for reimbursement of any losses greater than 100. That means up to 100 they will not compensate you. 250 is your liability. They will not compensate you up to 1 crore, 100. So what is your indemnification asset? 150. That's why no different language. Greater than. So they may trick you by this, by putting this example in one big question. Because these are all the part of your purchase considerations. In the fair value of net asset calculations, it's going to reflect. So they may use a language that reimbursement can happen greater than 100. That means indemnification asset is 250 minus 100. That means up to 100 we will not give you. Anything above 100 we will give you. 250 is my total loss. Out of total loss, how much I will not get? I have to bear X. That is your indemnification asset. Follow? Clear, no? Yes. There is one more exception called in-process research cost. Theory-wise, not much relevant. See, what is in-process research cost? Generally, when you conduct research as per Ind AS 38, can you capitalize? No. Research cost is not capitalized. When you can capitalize? The development cost you can capitalize. But it may be possible that somebody acquires a business who is into research. Somewhere that research is in a phase of happening. Like say, for example, me, I am into research from past 6 years. That research may get materialized in upcoming days. Somebody may observe this research. I may go to somebody, present my research paper and say, this is what I am planning to do. No, I will be acquired. My business will be acquired. But what happened? Can I recognize that research cost as an intangible asset? That's one exception. Generally, no. It says that in process research, IRPD and development cost, you can capitalize. Going forward, after you acquire, if you further incur research expenditure, no, charge to P&L as per Ind AS 38. See, when you acquired, you have paid money for that research, no? Capitalize it. You treat it as a different intangible asset. But once you acquire, if you conduct further research, then you apply Ind AS 38, you charge to P&L account, only development cost you capitalize. This is the theory. A Limited is a pharmaceutical group, acquires XYZ which is into a pharmaceutical business. Now, why did you acquire? Because they incurred a significant research cost for 2 new drugs that is undergoing clinical trial. That means it is in the upper stage now. Clinical trials are happening. What is that clinical trial? We will learn in Index 38, because we should know different stages of, because they will ask you questions like this. We have never done the audit of one pharmaceutical company, so we should differentiate, no? How many phases of trials are there? Out of the 2 drugs, 1 drug has not granted necessary regulatory approvals. However, ABC expects approval will be given in 2 years. Other drug is already given approval also. The drug's revenue earning potential is one of the principal reasons why you decided to acquire XYZ. Whether the research and development on either of the drugs be recognized as an intangible assets in the books of ABC at the consolidation level. Standalone level, nothing comes here. Standalone level, only one entry, investment account debit to cash. At the consolidation level, I will follow all these assets. No. When ABC invests in XYZ, who spent this research money? XYZ. Is it available in their balance sheet? No, it's expensed out. Now, when I paid the money, have I not paid the money for the research also? Whatever they have done and expensed out. That means this asset is not available in their balance sheet. Now, if I ignore it, whatever money what I have paid for research, where it will land up? Goodwill. Because there is no identified net asset, no. Because see, if they would have already recognized it, then that would have come as a net asset. They charged to P&L account, but I have paid money for that. So if I also don't recognize intangible asset, then it will go into one intangible asset called goodwill balancing figure. That's why standard says that, look, I understand research expenditure should be taken to P&L account, but if you have paid to somebody for their research, then instead of taking to goodwill, take to one intangible asset called IRPD. In process research, IPRD, in process research and development intangible assets, so that you can amortize it over 4 to 5 years. That's it. One exception, one theory, no practical question. So you have to refer that as per Index 38, you can recognize intangible asset only if it is identified, probable future economic benefits, and you can measure the cost. This is one thing extra as compared to Index 16. Now 103 says that acquirer shall recognize intangible assets separately from goodwill. Now when it comes to IPRD, generally internal research cost is not capitalized. However, acquirer can recognize if it meets the criteria, but subsequent expenditure should be taken to P&L account as per 38. If so, after you take or if you conduct research, you cannot capitalize it anymore. So further, probability of the benefits and reliability of the measurement of cost is always satisfied, because when you paid the money to acquire them, you estimate that fair value money is going to come. No, because if that research was worthless, ABC will never have acquired PQ XYZ. So you are paying money, that itself one indicates that that research has got a fair value. Therefore, there is a sufficient information to measure. Okay, now coming to drug 1 and drug 2, fair value of the drug reflects the probability that you can measure the benefits and fair value reliably. That means you are valuing them. It is identifiable. That is why you can recognize drug 1 as an intangible asset. Approval is pending, but still there will be future economic benefits going to come. That's why drug 2 also you can recognize as an intangible asset. So even though drug 1, drug 2 is not appearing in the standalone financial statement of XYZ, when you do the business combination, 2 new assets will come in your balance sheet. In CFS only, not in SFS. It is called drug 1, drug 2. And these 2 drugs are in the process research cost. These are not commercialized values. Followed, no? Yeah. Yes. Sorry? It could have been. That's what I'm telling. No. This is like why you acquired. Now, why you acquired them? Again, say I have not discussed more theory. There are more guidance in Index 103 when you acquire people in institute like this, like suppose you remember, you know one thing, in 1999, Yahoo offered a $10 lakh to Google search engine. Google rejected it. These two people, they were college students, $10 lakh. In 2014, Google itself purchased Yahoo. That is the story. So when somebody is doing research, you may acquire that research. So if you see into that research, there is no business process as such. Input, process, output is not there. But the Ind AS 103 has given so many guidances that yes, you can treat that not as an asset purchase, but it as a business combination. No, there are guidances. Again, we need not get into much because there is only one question on this. See, if you are really academically interested, what I suggest, after I finish this chapter, just open the study material, Ind AS 103, start reading. So many theories you will find, which is not discussed in the classroom only. No, that's what, no, that probably, that chances are, why I'm taking, this is my, I'm taking risk no here. And I'm giving you this question, not the other question. It's the risk I'm taking. My gut feeling, my pattern observation says that if at all any question comes, no, this is the highly probable question. That also may come, which is only 5% chance. So need not bother. That's why after you finish all, if you find time, I strongly recommend, please open the study material, read it once. Two things will happen. One thing, you will get a flow. You will understand what they are trying to tell there. And suddenly, second thing, you will realize that it is too much. Better not to study now at this point of time. If really in your if you want to become an expert later after you qualify CA, then it makes sense to study, and not at this point of time. At this point of time, your priority is this. But whatever you are discussing, let us discuss in depth, thinking what they may ask you. And this is sufficient. You can confidently answer anyone. Even in the interview also, they don't expect your expert knowledge. They will ask you certain basic questions. Okay. So my class is more like a base. Entity acquired two trade secrets called as secret recipes in a business combination. A is patented, B is not legally protected. How the acquisition of A and B should be accounted? Again, for this, no, we should have had some basic understanding of Ind AS 38, but I think in your inter also you had this. Ind AS 38 says that you can recognize an intangible asset only if it's identifiable. Now, what is identifiable? It should be separable or it should be legal. Legal means you should have applied for patent, trademark or something. Separable means you should be able to sell it separately, whether it is registered or not. Enough, we'll not discuss much. I'll discuss you with examples in Ind AS 38. You should have got the future economic benefits, you should be measured the cost. Thus, identified if it is separable or it is contractual. Acquirer shall recognize the intangible assets separately from goodwill, irrespective of whether recognized by the acquirer or not. So you don't go beyond the logic whether it is available in the acquirer's balance sheet. But if it meets this definition, if it is meeting this definition, then you can recognize it in your consolidated balance sheet. So as per goodwill should be recognized, goodwill is itself is a balancing figure. So in the given case, recipe A meets the contractual criteria because it is, you have got a patent. It is identified. Does it going to give future economic benefits? Yes. Whoever want to use, I have patented it. Third, can you measure the cost reliably? Yes. Recipe, manufacturing, like whatever salary I paid to that research people, patent registration cost, I know I can measure it. Recipe B is not protected. However, it can be separated, no? What is separability? That means, see, for example, my chapters are there. Have I taken a trademark for my chapters or copyrights for my chapters? Say, for example, no. Can I take one chapter and sell separately? Yes, that's called separability. Trademark means I have registered, I have got a copyright. That's whether I will separate or not, that's called legal. So one of the two conditions should have been followed. So since both the conditions follow in two different ways to two different intangible assets, even though they have not recorded, I can record it. I can recognize this. Okay, so enough. Let us go to the deferred tax part. Okay, this is what we discussed till now is a theoretical questions, theoretical thing. Now let us look into the deferred tax.